Good afternoon, everybody. It is 1:40 Eastern Time. Everyone's back from lunch. I am didn't really follow the crude futures over the lunch break, which was probably a good thing because they had just kind of really slowed down after that big run up. I'm in a trade right now, just kind of monitoring it. The Dow is up 196. The NASDAQ 100 has actually backed off quite a bit, as well as the composite. The NASDAQ 100 is only up 5 points. The composite's now negative 20.26. The S&P is up 0.4%, and the Russell's up 0.3%. The yield on the 10-year note, at least that index, is a little bit higher. It's 2.919. It was 2.914 before we broke for lunch. It looks like VIX is still down, but off of its lows for the day, as is the RVX, which is the volatility on the Russell 2000 index. That's the small and mid-cap stocks. And, futures, again, are pretty well synced with the cash markets. There's not a huge disparity between not necessarily the level that they're trading at, but, how far they are up or down for the day. Volatility futures are down, 8 basis points. So we'll be watching that to see if that turns or how that turns. The dollar index is down 0.3%. So it's down further than it was earlier in the day. So dollar exhibiting some weakness. And that's pretty much where things sit. No other economic data of note that I'm really paying attention to right now. I'm just going to double check and make sure I'm not forgetting about something. Yeah, it may be time to get out of these crude futures again. This has just been a big disappointment all day. I didn't catch the move up at all. No, nothing else coming up. Now, one thing I just saw that's interesting, and this is consistent with what we've seen across the other Treasury auctions. The results of the 7-year Treasury note auction have come out. The last auction, the yield was at 2.565 points. The yield is 2.839. So, for those of you who are familiar with fixed income trading or just bonds in general, yield and bond prices are inversely related. So as bond prices go down, yields go up. It's time to reverse this oil trade. As bond prices go down, yields go up, and vice versa. And it's not been, at least not to this point, it's not really been a question of, is there demand for government debt? The demand still seems to be there. It's really more a question of price or yield. And the bottom line is that bond traders, bond investors are seeing what's happening in the bond market in general. If they take a look at the global economy, they see the fact that the Fed, the U.S. Federal Reserve, is already on a path towards rate hikes. They know that European Central Bank is going to have to get there. The Japanese Central Bank is going to have to get there. The Royal Bank of England, the Central Bank of England is going to have to get there. And the writing's on the wall. So investors are going to have to take more risk. They see that. And in order to take that risk, they're going to demand a lower price, which correlates to a higher yield, a higher return on that investment. Okay, this is just, I'm getting out. This is just ridiculous. I'm just not even... Okay, now we're starting to get some signs of maybe not accelerating downward momentum, but the downward momentum's firming up a little bit. Before it was just a lot of chop back and forth. It was pretty much, and when you have that, that's basically an equilibrium between buyers and sellers. Or as close to an equilibrium as you get between buyers and sellers. I'm losing my patience with crude oil right now. I've not had, other than one good trade, I have not had good luck with crude at all today. It's just right now it is absolutely incapable of sustaining any momentum whatsoever, one way or the other. Just can't make a decision. And foolishly, I just stay in it. And I'm digging myself a deeper and deeper hole. So just forget it. I'm done. The frustration is just too great. Let somebody else. Let someone else waste their time. I'm not wasting any more time with crude. That will help. That's a much better. Basically, what this tells me is that the crude futures have found value. There is still index futures are still discovering. They're still going through a process of price discovery. Like, where is value? There isn't agreement between bulls and bears right now on where that value is. Now that we've walked away from the crude trade, it's probably a good time to point out, you'll see that whether if you're trading stocks or if you're trading futures, whatever, a certain if you pick a future to trade that's just not working for you, there's probably a reason for that. Either just the way it's moving does not fit your style or your temperament or your trading psychology, whatever the case may be. It's just it's just not working for you. And as you see, I'm not saying like you get in and if it doesn't work for you immediately just get out. But when you saw me flip that like 3 times, and every time I flipped it, that was all the signal it needed to go start moving back in the other direction. And after a while, it's like done. Don't do it anymore. I got into the Dow and I managed to read that right, and I got in. Didn't get out at maximum profit, but then I rarely ever do. So try as you might, if let's say you're trading gold futures, or you want to trade copper, or you're trading natural gas, or trading crude, or one of the index futures, whatever the case may be, and it just isn't working for you, then just dump it. Kick it to the curb. Walk away. Literally maybe pick yourself up and walk away from your desk and come back, and then that's a no trade for the rest of the day. Crude oil futures, you're dead to me today. I'm not even going to acknowledge that you exist. Other than when I take a look at it and now, so crude futures are up, whatever, it's at 62.76 right now. But as far as trading it, nope. Already had its chance. Already has proven itself to be absolutely untrustworthy. And I do like trading crude around the inventory numbers. It's not easy, but it can be profitable. And just in case you wonder what I'm doing, I'm drawing the patterns, the trend lines that I should have on the futures that I follow, but I'm not going to do that on the main screen because I want to watch what the Dow is doing. And the Dow is just making a nice leg up. I probably should have stayed in it. Maybe jump in on a pullback if we get one. Okay, this is getting frustrating as well. Okay, now we're looking like getting ready for this for a leg down. A little bit of noise below it though. I mean, that's the 4-minute chart. I'm looking at the 1-minute and the tick chart too, and there's moving averages that are going to be potentially, uh, inhibitors, obstacles, headwinds, whatever you want to call it. I'm not saying that I want to wait to blow through those because a lot of times you do that and then the move's just over. It looks like the momentum behind it is sufficiently strong that we can get away with playing this. And yeah, that was a nice little breakthrough. This close above the moving average wasn't the best thing to see. Okay, that's not. So, using the Dow to make up for some of the losses in crude oil. The only thing is that, and this is more an issue of options pricing than it is actual weakness in the VWO, but the VWO is only, it's up 15 cents, but my long, this is, like I said, this is just pricing anomalies, I think. You know, the overall position, which consists of 3 long calls that are at a 26 strike expire January 2019, have lost, 240, and my short calls against it, which expire in March, have gained $37.50, which probably tells you overall traders think the risk on VWO is to the downside. If you look at, I have access to these options statistics, but the put call ratio would tell you, like, this is very bullish. The put call ratio is, here, this is how many calls changed hands, this is how many puts changed hands. You divide the number of calls by the number of puts, and that's your put call ratio. Or you divide the number of puts divided by the number of calls, that's your put call ratio. It gives you a ratio of 0.009, that's your result. Anything below 0.75 is considered bullish. Anything above 1 is considered bearish. Between 0.75 and 1 is considered kind of neutral. So if 0.75 is the cutoff, then this is incredibly bullish on VWO. And I mean, maybe it is just that implied volatility is coming in. It could be that. I wasn't paying attention to what the implied vol was earlier today, but that's just my guess. I mean, if this is how bullish everybody is on VWO, then I can look at the volatility of the ETF itself, not necessarily what the implied vol is on the options, but on the underlying. And implied vol on the underlying has come in. It's dropped from about 22 to 20.8, which isn't a lot in terms of percentages. That's about a 10% drop. And here's about maybe a 5% drop in just 8 minutes. 18 minutes, I'm sorry. Now that can be good from the standpoint of if volatility is coming in, then that means that my short option is losing value and I can buy it back for less than I sold it for, even though, even if VWO was up a little bit. It's up 17 cents. So right now the stochastics on VWO tell a little bit of a mixed story. And I actually, I had an article published this morning that I wrote yesterday on VWO. Emerging markets in general, but specifically looking at VWO and, the composition, like what countries are represented, and the impacts of treasury yields and the dollar index, how is that going to affect the countries and the companies in those countries? On balance, if the dollar is strengthening, you would expect that to help countries that export a lot to the US. But one of the things that's a little eye-opening is when you actually take a look at it, if you go to the CIA World Factbook They can tell you where what GDP composition is. So how much GDP comes from domestic consumption across private consumers and business and government, and how much is exports, and then how much is imported into the country, and what's the impact of the dollar going to be overall. If I were to tell you, China, Taiwan, Brazil, Colombia, Mexico, just name off a few countries. I'm just naming countries off the top of my head that I know, South Africa, that are in that index. Most people would probably tell you how much do they export. Nah, they probably 50% of their GDP is exports, 40 to 50%. The reality is the composite of the total VWO is somewhere in the neighborhood of 32 to 33. So it's not as aggressive as people think it is, and so they're not as dependent upon a strong dollar. Strong dollar helps those exporters, but then keep in mind you're indirectly buying securities that are issued in another currency. So strong dollar helps those companies, but then when you quote unquote repatriate those returns, it actually it's a hit to your returns. So the long and short of it is, just because VWO was the darling asset class in 2017, or emerging markets were the darling asset class, VWO being the biggest ETF in terms of assets, just because it did well in 2017 doesn't mean it's going to do hot in 2018. There's a lot that's going to depend upon where the dollar goes, and also what the correlation is between the US dollar and Treasury yields. When the correlation is one way, whether positive or negative, it has one impact. When the correlation is another way, it has another impact. So I'm not going to give it away. Read the article. The link to my profile on Seeking Alpha, which will let you get into those articles, is actually in the channel description, as well as I think it's the description of every video is the same. It's all the same boilerplate, but there's a link there that you can click to get to my Seeking Alpha blog, as well as to get to my Seeking Alpha articles. Read it for yourself. It's pretty. I think that you'll find some useful information in there. I know it was definitely eye-opening and helpful for me as somebody who has exposure to that underlying security. Also in my description there is a link to my Twitter, my Facebook page. So if you follow me on Twitter, you'll get notifications when the Trader's Espresso for the written version is out, as well as when the video version is out. now we're seeing kind of a, or not, I shouldn't say now we're seeing, but one of the things I'm noticing here is this bunching up of these averages and the 9 period moving away from the 81 and the 27. That is usually a good sign. And that was a good time to get in. I don't know if you noticed it. Remember the purple plots here? That's the Bollinger Bands. So Bollinger Bands, basically it takes your, there's a moving average, which is the red one here, and by default it's usually 20 period. I modified it so it's 27, but then it does a plot on either side of that 2 standard deviations wide. Because I'm using Wilder's averaging as opposed to just a simple moving average, I think I changed it to 3 standard deviations. Which basically the reason why I did that was because I like to see, like when you look at history, you look at the plot, I want to see, even if price is moving down and Bollinger's bands are moving down with it, I want to see the prices for the most part contained within those bands. It's not very useful for me if most of the price action, if I just set that to 2 standard deviation, it would be outside of those bands. The reason why that's important is because I want to see when price is pushing those bands wider. When price is pushing those bands wider as it did just now, sometimes that's a signal to open it to get into a trade. And as you saw, as it started pushing it, I went long and it shot up. Now it doesn't always do that. Nothing ever always does anything. But if you know that that is a higher probability trade, which at the end of the day, it's not about predicting anything. When you're trading, your goal is not to predict. Your goal is to identify high probability occurrences that give you an edge. And to the extent that you can quantify that, the probability in your head helps you when it comes to calculating risk-reward ratios. If you can find a risk-reward that's 4 to 1, reward to risk that's 4 to 1, and you take a trade that's a coin flip, theoretically, that's a winning trade. Because 4 to 1, where your 4 is positive, is better than 50-50. It's better than 1 to 1, right? Now, of course, there's other factors, assuming that you don't let human psychology and emotions get in the way. As long as you master the twin enemies of fear and greed, and don't let it override your system. So I basically managed to erase my losses in crude oil. So that means I've cut my trading losses for the day about in half. It's about an hour and a half left to the close. So I'd like to cut that to 0. Ideally, I'd like to be positive. I'd like to hit my goal for the day. That may be a tall order, but we'll see, as long as I don't do anything stupid. The Dow is now up again, almost 300. So we're seeing some firming in the major indices, firming in the futures to go along with it. Now it looks like we're getting a little bit of a short opportunity shaping up. stopped right at that 9-period MA. And I don't generally like, it's a couple things. One is I don't generally like to trade against the momentum if I think the momentum is to the upside right now, which I think longer term it is. I also like to get into a trade where there's clear blue sky in the direction I'm going. So clear blue sky, what I mean by that is I don't really see any inhibitors like moving averages. I've got moving averages behind me. Now, if we watched it trade down here, if it were to break through and continue to trade down, then we've got clear blue sky all the way down to this 243 period MA. The problem is getting through there. Now, if I see that the momentum is behind me, which if I look at the tick chart and the 1 minute chart, looks like I might have it, but then it's also offset by the slow stochastic on the 4-minute chart moving up, fast stochastic on the 15-minute chart moving up. If I pull out and look at a 1 hour, so I zoom out, downward momentum here, upward momentum here, overall the histogram is shrinking. If I look at a 4 hour, the 4 hour tells me the long trade's not done yet. In fact, it's just beginning. See, now it broke through and it's making a big move down towards those moving averages. The better play right now might be a bump off of this 81. If you were to ask me the question, what is it more likely to do, bounce off of 81 or trade through, I would tell you my answer is more likely to bounce off of it. Doesn't mean it's going to be a big rip up. Click, click, click. I know I'm not talking, you're just hearing me clicking. I'm just kind of watching what it does right now. You know, like I said, it has so far failed to break through this moving average here. Now, that doesn't mean it can't do it. It's pushing through right now. The question is going to be, will it close below that? The momentum that we're seeing right now tells me that it can. Which I may open a short position on a pullback, which that wasn't really much of a pullback, but okay. So we're seeing this, buyers try to get back up above the 81 period moving average, and I'm not saying they're thinking like, oh, Tim uses an 81 period moving average, we need to get back up above that. No, it's moving back up above. Some traders out there probably have a 90 period MA on their chart. It could be a 100 period MA, it could be a 75 period MA. Generally, it's going to be in the same area. So that move up is now being pawed down by the bears. You ever wonder why they use the analogy of bulls and bears in the market? If you look it up on Google, I think you'll probably find this. This is what I've found, is that, and I guess it kind of makes sense. I don't know whether this really was the thinking behind it, but bulls kick things up with their horns and bears bat things down with their paws. So I guess it helps with the visualization. Like, I talked before about the value of, kind of visualizing what markets and traders are doing as you're in these trades. It helps a little bit. So what I kind of see happening now, and I'm visualizing this in my mind's eye, is nine period MA, 27 period MA moving down, 81 period MA sloping down. You've got three moving averages acting as a resistance point. So what I foresee happening, and this is what it's doing right now, is pricing, bulls pushing it back up to that level, right here, and the bears defending that line in the sand. So let's see if I'm right. I'm not going to do a trade, but let's just see if that's what happens. And if there's enough momentum underneath of it, which right now there could be, because no, that's not what I wanted to. That's weird. Hold on. We may be seeing a big move up forming here, which, if that's the case, then it's just going to blow right through these moving averages. On the other hand, looking at the most immediate chart, which is this tick chart here, we see the fast stochastic having crossed into oversold, kind of curving up a little bit. The slow stochastic hasn't completed its move down yet. This is telling you this is what just happened, right, and could continue. This is telling you now both the fast and the slow are moving down. This histogram could, these bars on this histogram could widen. What do you do in that case? Let's look out to the hour chart. The hour chart's telling us still bullish but weakening bullish sentiment. And the 4-hour chart, right, is telling you if you can hang on, if you can stomach a lot of fluctuations up and down, if you can hang on, this is going to be a very powerful move upward. It's already seen it from here, from this 243 period moving average, all the way up to here. Right, this is going to reclaim this territory here, but you're going to have to stomach some moves, probably down to about, well, if it'll draw, or okay, don't draw, down to about here. Well, if you're at 25,000 now, that's a 150-point drop. 150 to 175-point drop. That's about a $650 loss on one contract. What would the gain on something like that be? Well, if we can go all the way up here, that's about a $1,200 gain. But right now we're just seeing bounce, 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 bounce. We've already seen the faster moving average cut through the slower moving averages. The slowest of these is the 81. The fastest of these is the 9. The 27 is looking like it's going to cut through in the next 2 or 3 bars probably. So if that's the case, then I would target a move down to here. I wouldn't put that trade on just yet because I think we're going to still see a leg up to about here. And of course, it's going to make a liar out of me. No. The downward momentum that I'm looking at in the 4-minute chart looks like it might be sufficient to push this all the way down to the 200 period MA. You see it's already hit it, the 200, this moving at 200 period, 243. This moving average, it's already been touched. It is almost 3 o'clock, which means there's about an hour and 3 minutes till market close if you want to be precise. If you want to be real precise, it's 1 hour, 2 minutes, and 16 seconds. Now the target is down to this pivot point here. ATR is turning up, average true range. That's usually, since it's kind of a proxy for volatility, it's usually followed by, when I see price moving downward, I see ATR turn up. When I see price moving up, generally I see ATR to move down. If we go back to what we were looking at, that 1 minute chart, see that the 27 did cut through the 81. So fast moving averages cutting through and pulling away from slow moving averages is usually a signal of momentum in that direction. One thing that you want to be careful of is that it has this tendency, as it pulls too far away from, like this 9-period moving average, is going to be drawn back towards that. So you are going to see some push-pull. A lot of times you can use moving averages as a way of kind of buying the dip or selling the rip. So if it rips back up here, you sell at this point when it hits that. If this were upside down, you would buy when it pulls back to this moving average here. So we saw, this is important information, we saw a move up attempted and it just got batted down and it turned stochastics back down. So that's an important piece of information. Okay. That didn't pan out the way I hoped it would. And as you can see, we're getting a lot of bounce between the 81 and the 200. That's kind of a buzz saw, like a no man's land. Remember World War I? If you ever remember that in your history class. And now we've seen the Dow go from almost touching 300 to now only being up 150, so well off the highs of the day. The composite is down 9 points. The NDX is flat. The S&P is up 3.2. The Russell is down 0.33. So 2 basis points. The yield on the 10-year is holding steady at 2.917, so we haven't really seen any sell-off in the in the Treasury market like we saw yesterday after the Fed minutes came out. Dollar index is down 30 basis points, so 0.3%. Right now, this excuse me, this play appears to be the upside, at least approaching this moving average. That's why I mentioned take profits quickly. When a move peters out like that, and it gets you below your trailing stop, and here's the problem, is that what we're seeing on the 4-minute chart is painting a very difficult picture. This looks very bullish, this looks very bullish, this looks very bullish. This one here is telling you, it's giving you a mixed picture. Like I said, it's fast stochastic is crossing above oversold, but your slow stochastic is heading down towards that level. So this has to be resolved. There has to be a crossover. Or a reversal. Right now, the Russell futures are giving us a little more something to work with.
I don't think that helped at all. And here we are with about 33 minutes to go, 32 minutes to go. Dow's back up 222. and just because I didn't have it in view, but this and this, these crossovers happen simultaneously. That's the reason for opening that short. Just looked too compelling. Of course, it's not going to do me any good if it runs out of steam, right? And in this case, this was my entry signal. This was my exit signal. So once fast stochastic crosses or touches or looks like it's approaching oversold, a lot of times when it does that, you'll see a mild correction. Or it could be a big one. I mean, this is a pretty significant correction before this has the chance to leg down. So in this case, I'm using the stochastic plots in two different ways. I'm using it when I see that both fast and slow are overbought and they're turning down. That was my entry signal. And then when fast touched oversold, that told me it was time to get out. That is an approach that works better on the shorter time frames. If you're looking like a 1 minute or a 4 minute, in this case it was a 1 minute and a 333 tick, which right now those two are pretty close to being in sync. Now, as far as what you want to use, if you want to get back into that short trade, understanding that you've got these retracements, I don't think that your stochastics are going to help you. I think that your moving averages are what's going to help you more. Now, the problem is that here you don't have a lot of history telling you, like it has a tendency to bounce off of a certain moving average. You don't really have this. I mean, the closest that you have is on a tick chart, but that's only 4 bars of history. But you could try using it. Say you just like you've got your gut is telling you it's going to make a stop at the 9-period MA. Put a short, go ahead and open your short, put a limit order in right below that or right around that moving average. Have a tight stop, maybe 4 to 6 ticks, in case you're wrong and it just keeps going. It didn't even make it to that moving average, so if you put a trade like that on, it would have missed. Don't think of it as a missed trade, think of it as a learning experience. Think of it as basically you're getting free information. Because a lot of times you have to pay for the information. It is 1:40, 3:40 East Coast time, 5 minutes to the most volatile time of day. Now I'm almost wishing I'd never traded those trade futures, or not trade futures, traded those crude futures. At the very least, I should have stopped after that first one. Okay, just push through because I'm getting tired of these trades losing steam. All right, well, I'm almost flat for the day with only 17 minutes left. I don't know I'm going to do much better than that. So if I were to write down like lessons learned from today for me personally, it would have been go into it with a game plan, meaning, and I've done this before and I've kind of gotten away from it. If you pay attention to the news, headlines, business news, economic news, whatever, if you know what economic data is coming out, and if you're familiar with what securities are affected by that, so, crude inventories is going to affect RBOB gasoline is going to affect, crude oil is going to affect natural gas because inventory numbers for all three of those come out on, normally Wednesdays at 10:30 Eastern time. If you pick a handful of, like I have my, 12 future symbols I follow, but I'm not necessarily going to follow those every day. Some of those might not even be in play. I might focus just on the index futures and crude, for example, and have some chart drawings done, some trend lines or some price channels to kind of help you identify those patterns and trade those patterns, trade that momentum. I might have still had the same result because knowing that the crude inventories were today, I probably would have still said crude is going to be one of the ones on my radar. My radar today is going to be crude and the index futures. So the Dow, the NASDAQ 100, the S&P, the Russell. And I might have still traded crude and I might have still had the same or similar results. Going into the last 15 minutes of the day, it looks like at first blush the bears are going to have the day. Of course, every time I say something out loud, okay, I'm broke even. I'm break even on the day. I don't know if I'm going to make any more trades, but I'm ready just in case I see something that's too compelling to pass up. Because right now, like what we're looking at from across time frames is we've got trading below moving averages here, trading below moving averages here, clear blue sky below, trading below moving averages here, but coming into a 243, here coming into an 81, trade below both of those, and we've got line of sight to right about this level here at 2480, 24,800. That'd be another 100-point drop. That's a little much. Now, if we see on this chart, if we see price starting to aggressively push that against that lower Bollinger Band, that might be something worth noting. But right now, what we're getting is a hard push up. The bears successfully defended their line in the sand here, pushing stochastics back down below, back into oversold. We're clear below the 81 here. We're trying to push through the 243 here on the 4-minute. I changed this from a 15-minute chart to a 1-hour chart just to see what we were dealing with. So right now what we're dealing with is this right here. That is, that's tension. Those two being so close together. Until you get a crossover, you're really going to get a bounce up on the next histogram, which is, this is an hour, so it's going to be a while. But, I think this tension here, we're seeing it manifest itself in shorter time frames. And you're seeing the indecision. Push down, just kidding, push up. And the problem that we have now on the 4-minute chart is that we're now in kind of a quadruple buzzsaw. I mean, we've got the 27, the 9, the 81 and the 243. So you've got the slower ones on top, the faster ones on top rather, the slower ones on the bottom. Also seeing it here and here. So we're seeing moving average bands bunch up at the end of the day. Which on the one hand you don't generally like to see, but then you do, because those moving average bands are going to stay tight for only so long before they break one way or the other. Whereas yesterday we saw selling acceleration into the close, right now we're not. We're seeing more equilibrium, more hesitation. The Dow is well off the highs of the day, as are the other cash indices. This was yesterday. So the point of control as defined by time, in other words, right here where my cursor is, that level, that's where pricing spent most of its time. And the gray area represents the value area, so that's where 80% of time was spent at those price levels. If we look at today, even though we're up on the day, value area and point of control both built lower. Without making this look way too messy, so not really a lot of volatility. I wouldn't trade this though.
So this was the time point of control. This is the volume point of the control. So more volume took place up here. This is the midpoint. So this is 50% between high and low. This is a Fibonacci extension that I'm drawing here. If it will cooperate. Ding ding, the bell has rung. The closing bell. This will make sense in a minute. Basically, because we're seeing time point of control and value area build lower, this is where it wanted to spend most of its time. This is about where it closed. Okay, so this is basically anticipating tomorrow's action, a move lower, so value area continuing to build lower. We're seeing it here, 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 here. We're seeing value area build lower. Unlike a like a Williams or a RSI, your overbought, your oversold level are like 70% or 80% or 20 or 20 and 80 or 70 and 30. So what this is basically showing here is
the expectation as far as what's more likely tomorrow is that the market is going to want to build value down lower. You saw earlier on the monkey bars, this is where the market spent more of its time, but a bullish pressure pushed it up. So even though we closed up on the day at 165 on the NASDAQ, it pulled back quite a bit. I mean, we were up 300 at one point. So I would expect to see it trade down below this 24,858. And then maybe overnight, kind of trade in this range. Tomorrow when the bell rings, if you buy that, this is overbought and this is oversold, it really should trade down here at least to the midpoint. Now that would be a pretty big drop. But who thought the Dow would be below 25,000 2 months ago? Because it is. We were over 26 on the 26th of January. We're down over 1,600 points from that level. So anyway, those are my parting thoughts. Fortunately, I broke even on the day. Tomorrow's Friday, last trading day of the week. It's a shortened 4-day week because of the Monday holiday. So have a great evening, everybody, and we'll see you tomorrow.